Hello, good evening. So we are starting right away. Good evening, welcome. Hope we all had a good day. So welcome to Trade with Cryptoverse. We basically creating wealth nations, and you're welcome to our free 5 day boot camp happening for the next couple of 5 days, and basically we have an outline already that we'll be following. So trade with cryptovers is basically creating wealth nations, and this boot camp is going to run for 5 days, from tomorrow 8 p.m. daily till 20th. That's Monday till Friday, 8 p.m. daily. So please let's create time and attend. It's going to be very informative, and trust me, you are going to get value for your time being spent here. So basically, at Cryptovers, we are raising generations and equipping them to build wealth nations globally through financial education and skills. And in the next couple of days, we'll be looking at forex trading as a money making skill. Yes, and a couple of days, we'll be looking at day one, which is today, the forex overview and terminologies. Day two, we'll be looking at fundamental analysis. Day three, we'll be looking at technical analysis and precisely market structure. Day four, we'll be looking at trading psychology, risk and money management. And day five, we'll be looking at introduction to synthetic indices trading. And we'll also look at how you can actually get access to funding. Yes, those are the things we'll be looking at in the next in the days ahead. So basically, we focus on what we have for today, which is forest overview and terminologies. Thank you for your time being here. I always say something that formal education will make you a living, but self education will make you a fortune. We've all gone to school and we've studied one or two courses, and we are working currently with basically our certificate. But we all know that it's not what you learned in school that all of us are doing now in the real world. So that's why Forex said formal education will just make you a living. But the amount of time you spend in developing yourself is what will actually make you a fortune. Some of those skills that you have developed yourself in while in school or outside school, that's what is helping most of us now. So we being here and creating time for Forex is also an added self-education. And that's what will actually make us a fortune in nearest future. So in the next couple of days, we'll be riding the journey together, and let's see where God will help us and how far we can progress in this course. So in Forex, before you start earning, you need to learn. So you learn first. After learning, you take out the L in front of it and you start earning. So you learn and earn in Forex. That's how it is. And also, if you have the courage to begin, people always say they've lost a lot in Forex trading and the Rex. But it's basically because of lack of knowledge. Yes. Even the word of God says, well, my people perish because of what? Lack of knowledge. So if you have the right knowledge, you'll be able to excel in this industry. And for you to have the courage to begin, you have the courage to succeed. So tell yourself, I have the courage to succeed. So introduction to Forex. Forex is basically Forex exchange, which is also currency exchange. Forex trading involves at least two parties who exchange two different currencies between one another. There's this assumption I always tell my students that just assume you are going to USA, you are traveling out of the country, and you have the naira with you. You can't spend naira in US, so you need to change your money to US dollars. And someone coming from US coming to Nigeria cannot spend dollar tenderly in the market. He or she needs to change that money back to naira. So what you need to do is you go to the the Abuki guy and you tell him, okay, Malam, I need to change my money to dollar, and he changes it for you. You give him naira at a certain value, either 780, and you collect the dollar from him that you're going to use to travel at. Same way when you're coming back to the country and you have some dollar left, you won't spend it in Nigeria. You have to change back to naira for you to spend in the market. You give it to the same guy, and by the time you're coming back to the same guy, he's not going to. You sold it to him at 780. He won't sell back to you at 780. You're going to buy it from him at your naira at a lower price, probably 760 or 770, all depending. That's just basically what happens in forex. You are changing one currency to the other based on what is happening in the market. And as you change it from one currency to the other, you are making money. Just the way the Aboki guy is making money by buying the currency from you when you were going to US and also selling it back to you when you came back to the country. So it's making money. So that's basically what we do in forex. So when you're traveling out, you sold your naira and you bought USD. So basically, changes in the exchange rate allows you to make money from the market. Tomorrow dollar is 780, next tomorrow is 790, it drops back to 750. Those changes is what we look at in the market and we make money from. So basically, we buy what when we feel yes the currency price is what cheaper, and we sell when we want to know that yes this price is has gone to a level that I feel it might not go beyond. Then you sell. What's traded in forex? Basically, money is traded in forex, depending on the country you are and the rest. Money is being traded in forex, and there are different currencies to be precise. The currency price is actually a direct reflection of what is happening in the country's economy. As we are in Nigeria now, and our conversion rate compared to dollar is about 780. It's 780 because of our economy. Before now, it was what? Somewhere around mid last year it was around 575. Early last year it was around 400, there about 350. So in 1 year it has what double in price, just because our economy is not actually it's not growing per se, and due to the fact of inflation and a lot of things happening in the economy is what has made this value to appreciate. So if someone was keeping dollar in January and you are selling it January last year and you are selling it January now, you are making like times 2 of your investment. And there are a lot of currencies in the market, but we need to familiarize ourselves with these currencies. Of various currencies, so that we'll be able to know which and which we are trading. So in the forex market, apart from currencies being traded, we also have commodities. We have commodities, and we have stocks and indices, which are these things we are going to look at after now. Some of the major currencies that has been traded in forex are what we have towards the right hand side. What we have towards the right hand side. As you can see, USD is pertaining to the country United States. Their currency is dollar. So we look at Europe, their currency is euro. We look at Japan, their currency is yen. Great Britain, their currency is pounds. Switzerland, their currency is Swiss francs. Canada is Canadian dollar. Australia is Australian dollar. New Zealand is New Zealand dollar. And these are the symbols that connote this. These are the symbols that connote these various currencies that we have outlined. And also some of the things that is being traded in the forex industry is also commodities. Commodity involves what? Buying and selling of what? Raw products. Raw products such as oil, such as gold, such as coffee, and grains generally. Those tangible products, agricultural products, tangible agricultural products. Those are the things that are being traded under commodities. For example, during the Ukraine war, oil price went up. During COVID, oil price crashed. These are different instances that has affected oil, oil and gold. And as a forex trader, you look at these economic happenings and you are able to say that, oh, it's time for me to buy this commodity, or oh, it's time for me to sell this commodity based on your knowledge of the market. One other thing that is being traded also in the market is what? Stocks and indices. Stocks is basically an equity in the security of stock is represents what? A fraction of a company's equity. So we learned that okay, Access Bank shares, Union Bank shares, various Dangote shares, these are actually what? Stocks. So from the slide, we look at that a stock is what known as what? As equity. Is a security that represents the ownership of a fraction of the issuing corporation. Unit of a stock is called what? Shares. So what? As a shareholder or as a person that is buying a stock of a company, you are indirectly what? A shareholder of that company because you are buying a part of their equity, a part of the company's equity. And also what is traded again is also what? Indices. An index measures what? The price performance of a basket of securities. That's a basket of various stocks, a basket of various commodities or various currencies using a what? Standardized metric methodology. An example of these indices is what? NASDAQ. NASDAQ measures what? The top 100 companies in the UK. US 30 measures what? The top 30 stocks in the US economy. Apple, Yahoo, Facebook. So it measures that. Germany 30 also what? Measures the top 30 stocks in the German economy. S&P 500 is a list of the 4,500 companies. So that's what? S&P stocks. So a collection or a basket of these stocks are also traded. So with the right knowledge, these are the things. And we also have what? Crypto is not here. We also have what? Cryptocurrencies are also what? Being traded in this market. So what are the four things that are traded in this market? We talk about currencies, which is what? Money. Currencies are traded in the market. Stocks are traded in the market. Indices are traded in the market. And what? Cryptocurrencies are traded in the forex market. But majorly, we'll be relying more and looking at more of what? Commodities and currency trading. Because that's basically what we'll be looking at more. So forex market is what? A global market and is the largest, most active and most liquid financial market with a daily transaction of over $7 trillion. So the market is big. So a daily transaction volume of what? $7 trillion actually pass through the forex market. Exchange of one currency to the other. Buying and selling of various currencies of various countries. So looking at this volume happening in the market, volume of transaction happening in the market, it's a lot and we just need to take advantage of it. Forex is considered as an what? Over-the-counter market because it runs electronically and it's what? Continuous for what? 24 hours. So why it's referred to as an over-the-counter market is because what? We're not buying it physically. When we say we are buying gold, we are not buying the gold itself physically. We are buying an electronic version of this commodity. When we say we are buying USD, we are not buying it physically. We are buying an electronic version of it. That's why it's called what? An over-the-counter market. Because what is in all what we are discussing are in electronic format. Either gold, because we're not US oil, all these shares and stocks that we're buying, they are what? In electronic form. And what forex market is also what? A decentralized as what? There is no central exchange involved in terms of forex trading. There's no central exchange. Sorry, the network threw me out. I just switched the network. So, like I was saying, you don't need to be glued to your system 24 hours. Once you analyze the market, you know when to when to continue. So we go to the next slide, which actually talks about the forex brokers. As I said earlier, in choosing a forex broker, choosing a forex broker will be the first crucial decision you will make as a new trader. So before you come to the market and you want to start trade forex, all you need to select a broker that you feel you are comfortable with, that you feel you can actually be trading with, and a broker that that is good, and they are not really doing well, a lot of things happen in the brokerage business also. So one needs to be careful that yes, you're actually trading with a genuine broker. So in order to trade forex, you need a trading account with a provider of online foreign exchange trading, or CFD trading, commonly known as what? Retail brokers or CFD providers. So when you open a trading account with this company, you need to deposit money to the account so that you can trade. That's one. And also, you need to make sure that what there is what actually, for every forex broker you're actually trading, you need to check their site very well, and that what there is a what legally incorporated company behind that website. And also, after looking at that, you need to also look at they have a regulated body, whereby most brokers will always state the regulations they are working with, either Mauritius, South Africa, Canada. So there will be licenses and regulations. They will always state it on their site. So if there's no legal company behind this website, you need to know that this broker is not a genuine broker. So you need to look for another broker that you can actually trade with. Because there are some brokers that is, once you deposit money into the account, for you to withdraw it becomes a problem. And you don't want to fall a victim of that. Don't fall a victim of that. Don't be fooled by a listed address on their website. You need to make sure that what there is a real office behind that address. And the broker was what must be licensed and regulated. The purpose of regulation is to protect you from undisclosed financial risk, abusive practice like price and other manipulations and fraud. So we need to be able to look at these are basically some of the things that we look at from the website and be comfortable that yes, these guys are legally incorporated as a company. They have a physical office either in your country or in the location where they're operating from. And also make sure that well, they are licensed and regulated. They are licensed and regulated. Brokers that are licensed and regulated, we always state it on their website. Those that are not licensed and regulated will not state it. So always look out for this on those websites. And like I said, the purpose is basically to what? To protect us from what? Undisclosed financial risk, abusive practices like price and other manipulations and fraud. So some people say forex trading is dangerous, but for me, I always tell people that investing in anything with a lack of knowledge is actually dangerous. You don't know anything about um, how to fry puff puff now, and you just come into the market and you don't start selling puff puff. Is either you sell it too small or too cheap or too expensive. So in forex space also, if you don't have the right knowledge, it's dangerous. So investing in anything with a lack of knowledge is actually dangerous. So moving on, we've basically covered the introduction of forex. So we're looking at some of the terminologies in forex. So when you hear currency pairs, what comes to mind? A currency pair is a quotation of two different words currencies, with the value of one currency being quoted against the other. The first listed currency is called what? Of the currency pair is called the base currency, and the second currency is called the quote currency. Currencies are identifications by what? The International Standard Organization, and it's what's listed in three alphabetical codes, which stands, which the two alphabets stands for the country, followed by their currency. So the first two is the country, last one is the currency. So when you see NGN, that's what the NG there is what? Nigeria. And the N that follows it is what? Naira. So when you see USD, the US there is the country. And the D that follows it is the Naira. So when you see those codes in threes, alphabet like that, you know that the first two is the country and the last one is the Naira. So when you trade in the first market, is either you buy or you sell this currency pairs. So you always see the currency in pairs like this. Euro USD. You always see it like this. USD Naira. You always see this currency in pairs. And like I said, the first one is the base currency, and the second one is the quote currency. I will explain this as we continue. So when you trade in the forex market, you buy or sell in currency pairs, and the exchange rate is relative price of two currencies from two different countries. Exchange rates fluctuate based on which currency is stronger at the moment. So based on what? Which currency is stronger at the moment? Okay. So let me quickly explain the base currency and the quote currency. Now, the base currency is the first one. So when you go to the market and you see Euro USD, meaning what? You are buying euros using USD. When you see USD Naira, meaning you are using what? Naira to buy dollar. Just when you are traveling, you are buying $1 for 780. So you are using Naira to buy what? Dollar. So from the base currency is the currency you are buying, and the quote currency is the currency you are using to buy the other pair. Just understand it that way. And when we look at what bid price, because in forex space you always see two prices against all these currency pairs. So the bid price is what? The price at which what the broker is willing to buy this currency in exchange of the quote currency. The bid price is the price at which the broker is willing to buy the base currency in exchange for the quote currency, which is also the price at which traders sell the currency to the broker. The ask price is the price at which the broker is willing to sell the base currency in exchange for the quote currency, which is also the price at which what traders buy from the broker. So looking at currency pairs, there are three types of currency pairs. We have major currency pairs, we have minor currency pairs, and we have what? The exotic currency pairs. The major currency pairs are the currency pairs that are quoted with USD. So any currency you see in the financial markets quoted against the USD, they are what? Major currency pairs. And they are the most liquid and most widely traded in the market. And they have a very tight spread. So this is a list of the major currency pairs. So we have the what? The Euro USD, we have the USD JPY. Euro USD is what? Euro and USD and United States. So we are comparing them now. So any currency that has USD, they are major pairs. GBP USD is also a currency quote. USD CHF is a currency quote. USD CAD, AUD USD, NZD USD, all these currency pairs with USD attached to it, either before or after, they are what? They are the major currency pairs. And cross currencies or minor currency pairs, they do not have USD attached to it. So they are what? Minor. Those are the currency that you see like Euro CHF, Euro GBP, Euro CAD, Euro NZD, Euro JPY, GBP JPY, GBP CAD, Euro CAD. Those are the minor pairs. And the exotic pairs, these are pairs that has what? The USD with currencies of the emerging economy or the developing countries. So which currencies are the developing economy and developing countries? We have what? Brazil, we have Mexico, we have Chile, we have Turkey, and we have Hungary. So most of us have been hearing some currencies like USD ZAR is a South African. South Africa is also a developing country. This is a South African currency, and it's also part of the exotic pairs. You have so these are just the currency for USD Brazil, USD Hong Kong, USD Saudi Arabia, USD Singapore, Singaporean dollar, USD ZAR, that's USD against African rand, USD Thailand, USD against Mexico, USD against Russia. So these are the exotic pairs that we have. So far, I don't know if we have any question before we go into some of the other trade terminologies. Okay. I don't see anybody raising hand. So if there's no question, we'll continue. So when you hear PIP in Forex, PIP means what? Percentage in profit. PIP means percentage in profit. PIP is the what? Unit of measurement for the change in price of the currency pair. And it's also the fourth decimal place of a currency pair, quote, except for the pairs quoted in two decimal place. And a pipette is 1/10 of a pip. A pipette is 1/10 of a pip. So when I talk about pip value, is the price attributed to a pip move in forex trading. So when currencies move, they move in pips. That's when price changes. Like we said, pip is a percentage in profit and is the measurement of change in price of currency pairs. Is a measure of change in price of currency pairs. So that's basically pip. And like I said, it's the is in the what? The fourth decimal place. So example for Euro USD, when you look at it on various exchanges, the fourth decimal place is the pip. So as the fourth decimal place changes, the pip changes. As you can see, Euro USD, the price is just for example, though that's not the current price in the market. It's a 1.12345. The five there, the fifth decimal place, that's a pipette. We don't count that. You always see it very small on your exchange or on your MT4, MetaTrader 4, and the rest. You always see it very, very small. Then we look at the fourth decimal place is actually what? The pip. As you can see, 4 there means 4 pips. Then the third decimal place is tens now. That 3 there means 30. So 30 plus 4 pips. That's what? 34 pips there. So as you move those decimal places, it moves in tens. So the other thing to also look at is for lot size. A lot size is the number of currency units you buy or sell. Let's look at the lot size. Let's look at it below from the table to the right. Let's look at this one at the bottom. One standard lot size, that's 1.0 lots. That's what it means. One mini lot size is 0.10 lots. One micro lot is 0.01 lots. One nano lot is 0.001 lots. So what does this lot mean in naira and kobo, in dollar to be precise? One standard lot equals what? $10. So if you open a trade in the market and you use one standard lot size, meaning for every pip in the market, each pip is $10. I take it again. One standard lot size is 1.0 lot. So when you open a trade and you use one standard lot size, a pip value of one lot size is what? $10. So when one pip moves, when a currency moves 20 pips, you are going to do what? 20 times $10, that's 200. 1 million lot size, which is what? 0.1 lot, equals what? $1. So when you use 0.1 to place a trade, for every pip movement, you get $1. For a micro lot, 0.01 lot, when you use 0.01 lot to open a trade, once the trade starts to move, every pip movement, you get what? 10 cents. So when a currency price now moves for 10 pips, you get what? $1. And this lot size is actually what? Depending on your account balances. We're going to get there. We're talking about risk management and money management. You know the right lot size to use on your accounts. So, spread. What is spread? Spread is the difference between the ask price and the bid price. We explained this before, that the ask price is the price that that's it here. That the ask price is the price that the broker is willing to sell the base currency in exchange for the quote currency, which is also the price the trader is willing to buy from the broker. So the difference in the bid and ask price is called spread. So the difference in the bid and ask price is what? Spread. And as you know that the bid price is measured in what? Pips. The ask price is also measured in what? Pips. So forex brokers basically make money from charging you what? Spread. That's why when you're opening an account with a broker, you want to be sure that yes, the spread is what? Tight. The broker is not charging you too much for selling a currency quote to you or for buying a currency quote from you. So you need to take note of the spread of most of the currencies on various brokers. Because that's the only way, that's how the brokers make money. And you need what? This spread to be tight so that you will make more money in the market. So when you hear the word long, what does it mean? Long means to buy. Long means buy in forex trading. This means buying a currency pair. We long a currency pair that we anticipate of what? The currency pair is going to appreciate against the other one. So when we say long, we mean what? To buy a currency pair. And when you say what? Short means what? To sell. Meaning we are selling a currency pair. When you say short, we short a currency pair that is going to what? Depreciate against the other one. When we look at market and we are thinking, or we anticipate that okay, yes, this currency pair is going to drop. We now say, okay, let's short it or let's sell it. So from our trading account, there's what we always what? See balance. Once we open our trading account, I'm going to drop the link, various links for various brokers that we can use to open our trading account. So one on the Telegram group. So once I drop that, you can actually pick any of the brokers you want to use and open an account with them. Yes. So when we see balance is the amount in your trading account. Balance is the amount of money that you have deposited in your trading account. And also when you see what equity, equity is the current value of your trading accounts, which is the sum of the balance and the floating or unrealized profit or loss. You know, when you place a trade in the market, is either the trade is in profit or the trade is in loss. So if the trade is in profit, equity means your balance plus your profit. That's your equity. So if the trade is on a loss, which is minus, it means your equity will be what? Your balance minus the loss that you are on. So floating profit or loss is what? The unrealized profit or loss from the current position, from the current what? Open position. And this fluctuates as the current market fluctuates what? With the current market value of the open positions. So, like I said, floating profit or loss is what? Unrealized profit or loss from the current open position. This fluctuates with the current market value of the opened positions. So, leverage. Leverage is the use of the broker's fund to increase one's trading position beyond what would be available from traders' balance alone. So, when you fund your account with little money, like you said, that the benefit of trading forex is what? Low cost and low capital. So leverage is the use of brokers' fund to increase one's trading position beyond what would be available from traders' balance alone. Forex traders often use leverage to profit from relatively small price changes in currency pairs. So that's what leverage is. Leverage is what gives you what opportunity to take what place more trades using the broker's fund. So when you open your account, you always see a place where you can adjust your leverage from 100, 200, 300, 400, 500 to 1,000. So brokers even have up to 2,000. Excess, they have up to 2,000 as leverage. So you can actually use any of them. So leverage actually was helps you to place more trades. And what we also have a terminology that is called what? Margin. So when you fund your account and you place a trade, margin is the small amount of capital or money that is required to open a position. Assuming you fund $100 in your account or $500, what you actually need to place a trade is not the old money. You just need a certain amount, or let's say like $5 or sometimes $2 is what you need to actually place a trade in the market. So that's what margin is, the small amount of capital or money required to open or maintain a position in the market. And free margin is the amount of money or capital available to open what? New positions. So when we talk about free margin, is the amount of money or capital available to open new positions. Free margin equals what? Equity minus margin. We already discussed what equity is. So our equity minus the margin, that's what our free margin is. And we have what? Margin level. Margin level tells you of your capital, what the available capital you have in your account, what it can actually what buy for you. So trades will be open when margin trades will not be open once your margin level reaches 100%. most time you always see. Okay, sorry, I'm back. Network. So, like I said, forex trading, forex trading accounts allows you to use leverage through margin trading. The higher the leverage, the lower the margin. So when you open an account now and you select a leverage of 500, for example, the lower the margin required to open and maintain positions. So when you select a higher leverage, the lower the margin required to open positions for your trading account. So when you hear margin call is a warning notification from a broker demanding for additional funds in your trading account. So meaning when you are using a very low fund to trade, or your account has gotten to a level that I don't know where. So limit market orders. Okay, I don't know where we stop because and you just see that okay, so market orders. So market order is an instruction given to the broker to execute trades at a specific. So market order is an instruction given to broker to execute trade with specific details. So we have what we call what the entry order, we have the stop loss order, and we have what the take profit order. So under the entry order, we have what market order. Market order is an order to buy or sell immediately at the current market price. While the limit order is used to when a trader believes that price will reverse at a particular price or level. So we use limit orders then. So we use buy limits in an order to it's an order to buy at a specific price, and sell limit is an order to sell at a specific price. And what we call what the stop order. Stop order is used when a trader believes that price will continue to move beyond a certain or particular price level. So we use of stop orders. So there are two types of stop orders. You have the buy stop, which is an order to buy when a price goes above a specific price, and sell stop is another to sell when price falls below a specific price. As you can see, buy stop is what? When price goes above a specific price, we sell what? Keep buying. And we sell stop when price falls below a So as you can see, stop loss is an order to liquidate or close positions when price reach a level to prevent more loss when the market moves against you. In a long position, stop loss order is set below the entry price. And in a short position, the stop loss order is set above the entry price. And a trailing stop is a stop order that is defined by a percentage, amount, or price away from a peer current market price. So take profit order is what? A take profit order, as the name implies, take profit. Is an order to what? To close an open position, to book your profit at a specified price. In a long position, the take profit order is set above the entry price. And in a short position, the take profit order is set what? Below the entry price. Patience is the key to a profitable trade. So, in all that we have been saying, looking at the Forex overview and some of the terminologies that is being used in Forex trading, so be able to understand what is Forex trading and what are the other terminologies that is being used in Forex. So I'll be dropping the links for the um, account opening for the two brokers or three brokers that will be using during this training or during this boot camp. So you can sign up with them so that as the class goes on, we continue from there and we also explain some of those things on MT4 or MT5 as the case may be. Yes, I want to thank you all for your time. And if you have any question, you can actually raise up your hand. We answer, and if there is none, we can call it today and we'll continue tomorrow. So the recording session will be shared on the Telegram group and also on the YouTube channel. So you can come back to listen to it at our leisure. And also for those that are not available online at this point, they can always come back to it and take or listen to it again. So I'll stop the recording here before we end the session. Thank you all for your time and let's have a good evening.